Hi, everyone. This is Tamra Wade with the Tamra Wade Show. I'm excited. We've got our repeat guests, Jason Smith and Matt DeCicero of Southeast Mortgage here. And so today we're going to hit on a topic that I think is really important right now. And it's always has been. I've been in real estate over 20 years, and it never surprises me that people don't know the do's and don'ts of when you're getting a mortgage, or so when you're in there getting a loan. And so I figured today we could talk about that. And I'm going to let Matt lead off because prior to this, we were just chit-chatting and getting ready for the video. And he brought up one scenario he's dealing with. And so we'll kind of go off of some real life scenarios that are out there right now.
Yeah, credit do's and don'ts when trying to obtain a mortgage. So what most people don't realize is that you kind of need to be careful when you're in the middle of the mortgage process, especially if you're building a new home and it's going to be 3, 4, 5 months before it looks like the home will be built and you'll close. So although the lender does a lot of due diligence on the front end to make sure you qualify, it's always important to remember that you need to remain qualified until you actually close. And so the scenario that I was actually giving Tamra before we started to record this afternoon was that I recently had a client, recently as in yesterday, that is purchasing and building a new home in a community, and we were alerted that she went out and purchased a new car. And not only purchased a new car, but purchased a very expensive new car. And so, unfortunately, in her case, it's preventing her from qualifying for her new home. And one of the things we like to do here at Southeast on the front end is you've got a great piece of collateral that we distribute to all our clients, which actually has on it a list of certain things to do and not to do during the loan process. One of which is don't make any large purchases without contacting your mortgage loan originator. And unfortunately, in this case, that was not adhered to. And so here we are trying to figure out, how to unwind this. And it's an unfortunate situation for everybody involved. So we try and prepare people as best they can, but they need to then follow those instructions during the process to make sure that nothing happens that'll prevent them from getting a closing. So,
and it's hard to unwind that one because once you're in on a car loan, it's not like you can back up and punt. I don't know if they still have that. Is there like a 3-day rescission type thing or anything anymore with cars? Or
I don't think so. I mean, we actually had this come up on another file that I wasn't originating, but was associated with on the builder side here around December. And really the only thing you can do, as I understand it, is either have it refinanced out of your name into another family member's name so that it no longer appears on your credit, or, another option in that case, and the way we resolved it is the buyer actually brought the car back to the dealership, and the dealership bought the automobile back from the buyer at a discount. And so they had to make up the difference, which was really an unfortunate situation, but they wanted the home more than they wanted the car. And so it just reached a point where they had to do what they had to do. So, wow. You once you roll off that lot, as I understand it, you own it. So.
Wow. So Jason, what do you have that you've run into lately?
Yeah, so I was just, earlier today, we ran into an issue with one of our buyers. We've been under contract for probably over 6 months with her, and she's a veteran. And she failed to mention to me that before the house was going to be ready, that she was going to retire with the VA. And so, she had great income. She'd been in the military for many, many years. And so all of a sudden her income's getting cut in half. And so we're kind of getting stuck now. Half the income's gone. It was already kind of a high DTI loan, meaning she was kind of at the ceiling of her approval. And now we're getting half the income swept out from underneath us and trying to, see what debt we can pay off. It's going to end up costing her, probably $10,000 to $15,000 worth of debt payoff to make the deal still go through. And the lady had no idea. She knew she was retiring, but she didn't think that she would maybe need to bring it up. Since we were in the middle of the loan process. And we have to, when you're building a home, we're checking pay stubs all the way up to the final 30 days of closing. So when we get those new ones and it's got less income, it throws up a red flag to the lender. And then all of a sudden we've got to peel back the layers and figure out what's going on. And unfortunately, this one's, set to close in, less than 3 weeks.
That's tough. That's really tough. What about credit cards?
Yeah, we can talk about those. I deal with this a lot. So, people, obviously when you're building a home and you're waiting all this time, all these sales are going on. And, they're seeing the 4th of July sales, the Memorial Day sales and all this. And so they're like, oh, I can save some money and go out and get all that furniture. And, I'm just going to run it up on these credit cards. And they think that we're not going to really see it. But what a lot of people don't realize is there's a lot of systems now that we are monitoring your debt. We have a service that we are part of as you're building a home. We can see when new things hit your credit. And so what that does is it alerts the lender, and then we have to dig in and say, all right, we see that you open these new accounts or the balance changed drastically. So now we have to update that new payment in there, and it can blow an approval. If you have someone that just was barely squeezing by for that approval, which is, happens more than none, taking a credit card payment that was $100 a month and running up a $10,000, set of furniture on it, and all of a sudden it's a $300 payment, it can, you can lose an approval. And so people don't realize that, and they think that we're not going to see it. But we have, many ways that we're attached to that client until we close. And so that's just the lender doing their due diligence. And so I try to instruct people that don't change. You can only balance as you can change this if you want to make it less. Never increase your balance, make your normal payments, don't pay the credit cards off and close the accounts, keep everything as normal as you can from the time you got your approval.
Gotcha. So, there's been times where I've heard people or lenders say, don't pay off everything sometimes because that can affect your credit. And why does that happen?
More often than not, it does not make sense. I was actually looking at a credit scenario today with a buyer just to try and figure out some credit score information and unwind some things to help somebody qualify. And more often than not, paying your credit card balances down, not to zero, but to a balance of about $10 improves your credit score more than paying that account down to zero, believe it or not. There are some myths out there where everybody goes, oh, well, here again, I hate to keep using examples, but I was talking to a guy tonight at, 4:30. He's like, well, all my credit card balances are 30% of the available limit. And I'm like, well, that's great, but 30% is a magic or mythical number that's out there in the marketplace. Usually about $10 is where you see the most magic happen when it comes to your credit score. Why? I don't know. The credit bureaus intentionally don't let us inside the black box so that we can manipulate credit, but we can work based on our experience, and just $10 seems to be that magic number. Great example. I had a buyer about 7 or 8 years ago. I was actually refinancing a home for.
Sorry, guys.
and it was a jumbo loan, and he needed to have a 720 credit score to qualify, and he was at a 695. He had a Sears card that he went out and bought a water filter on for $65, and that water filter $65 purchase caused his score to jump from 695 to 740 so he could qualify. So in that case, it actually worked in reverse, where using some credit helped. But generally speaking, about a $10 balance on cards is where you want to be.
Yeah, I've had the same exact thing happen, kind of to piggyback to that. So I got to watch it firsthand. I had a client that we were doing a rescore with, and same thing. He wanted to pay it down to zero, which, most people, if they're going to pay it down to $10, they would already go ahead and pay it down to zero. Well, I sent him the analyzer and said, hey, I think it was a Home Depot card, and it needs to be $10. Well, the guy sends me a letter stating it's a zero balance. And so, I asked him, I said, do you want me to proceed with this rescore with this? And he said, yeah. I said, well, I don't recommend it, but let's just go ahead and do it. It increased his score maybe 10 or 11 points, and it wasn't enough to get us what we needed. So I had to call the guy back, literally take him to Home Depot, tell him, charge something on there, $10, get me the documentation, let's resubmit a rescore. Came back, it increased his score like another 40 something points.
Yeah.
And the guy was just blown away. But I said, listen, I said, this is why we have these analyzers and these systems to be able to predict that for us, because it runs everything through an algorithm and it knows exactly what the Bureau wants. And so, it doesn't sound, always makes sense, but those things are typically very accurate from my experience with them.
Yeah.
What other things would you recommend? I guess some more do's and don'ts. So we've talked about credit card, talked about major purchases. We talked about retiring. I guess the other thing would be what about changing jobs?
Yeah, I can talk about that.
Yeah.
I deal with that one a lot. All right. So, a lot of people, are flipping through jobs, things like that. If you're in a, home build and you're building a home for 4 or 5, 6 months and this good job opportunity jumps in your lap, a lot of people, they'll forget that they're in the middle of buying a house and they'll just go take the job. Well, sometimes it's not a problem, and I would say most of the times it's not, because they'll usually go for a job that's more money. Where you can run into the problems is how you're paid. If you left a salary job and you went to an hourly job and you don't have a history of an hourly job, even though you may be making more money per hour at the new job, now we have nothing to average backwards on. So sometimes that runs into a big issue with underwriting. If you're switching from one salary job to another salary job, it's usually a piece of cake, no hiccups. If you switch from a job that's hourly to now a full commission job, even though it's a W-2 job, you might not have a history of receiving commission, so there's nothing to average over the last 24 months. Even though you might be making double the money now, there's nothing to prove it. Because only salary is the only thing that is going to allow you to project forward. All your commission, your hourly rates, bonuses, stuff like that, they're going to look over a 24-month history. So if you're not changing from like pay to another similar pay, you can run into a huge problem.
I had a client of mine that's in banking, ironically, come to me, a past client. He was a salaried guy making 150 grand a year, come to me looking to buy a new house a few weeks ago, and he switched banks, and the new bank was paying him a third of what he was making in salary and the rest in bonus. And he was looking to buy a new house. I'm like, you're sunk, because I can only use your base pay to qualify you. You've never made bonus or commission before. It's brand new. You got to qualify off your base salary. And he was just flabbergasted. He's like, but I'm going to be making another 40, 50, 60 grand a year. I said, well, you might, but we don't know that. And so until we can actually document it, which I think Jason made a good point on, anything that we qualify you on has to have a history, and we need to be able to document it. And if you don't have a history of it yet, and because you don't have a history, we're unable to document it, it's as if it's not there. So that's would be a good rule of thumb.
And kind of a piggyback on this topic, I run into a lot people, maybe they know they want to buy a house and they have a full-time job and they think, well, how can I make more money to go buy this house? So they'll go pick up a part-time job. And so they'll call the lender once they've got both jobs rolling. We'll ask them how much income they have, and then they'll start sending these multiple pay stubs in. And they think, well, I've got 2 jobs, I can use all the income. But once again, when you work 2 jobs, even if they're both part-time or both full-time, or one's part-time, one's full, you've got to show a 24-month history that you have carried both jobs, because the underwriters are super smart. They know that people could go get a part-time job making an extra couple grand a month, close that house using all that income, then all of a sudden go back to their normal job. So they're going to sniff that out. And they're very, very cautious using 2 employment incomes without a full 24 months of history. And they don't like gaps. They don't like you changing, what the part-time jobs are. It's very tough to use both incomes, but I see this a lot.
That's definitely good to know, because, I've had that happen where people are looking and they're like, what if I got another job, we can just afford a little more and get a little bit of a bigger house. And I didn't even think about that, and I've been doing this a while. The other thing is, even like you, I guess if they're qualifying for some of these down payment programs and then they go get another job, right? Because some of these down payment programs are based on their income. And so they could actually have more. I don't know how often that happens, but I guess it could, is one of the scenarios.
Yeah. It happens almost in reverse on those, because they'll go, maybe they've got the part-time job and you tell them they're making too much money and they'll go, I'll just go quit the part-time job. It doesn't work in reverse either. So
that's true. Yeah, that's true.
Yeah, most things in mortgage are done on 24-month averages, for the most part. And so your history doesn't lie. 24 months back, that means it's pretty solid. It's not something that you just woke up and decided to change to manipulate a mortgage or to get qualified for a house. So that's why they have it in there. And it's hard for someone, like I've had some of these nurses pick up 2 full-time jobs as a nurse because they may work 3 days on with one company and then 3 days on with the other. So it ends up, really being a 6-day work week, but they've got 2 full-time jobs. But the underwriters want to make sure you can maintain it if you're going to use that income to qualify for the new home. And, it's tough to maintain 2 full-time jobs for a solid 24 months.
Yeah, that's a good point. One of the other things, I guess, that just recently came out this past week was the change with Fannie Mae and Freddie, right? It was the one with the self-employed and the documentation that has to be provided. Like I already felt like when we've had to provide before, it's because me being an independent contractor, it's all I know. And it's been, providing, you feel like you're providing everything other than your last born. So, or firstborn, whatever. But, what is the big change that's come up with that? You can explain it better probably than you can.
I got that one. I'm actually dealing with it right now on one of my friends' refinances. He's a real estate agent and a roofer. He's got his own company that he runs everything through. He's, an S corp, and we're getting hit with this right now. And so what they're requiring is you either send in an audited P&L for the year to be able to show that their income is still streaming the same as they're claiming on the returns, or your second option is you can do an unaudited profit and loss statement, but then you have to add in 2 months of the most recent business bank statements. And what they're going to do is the underwriters are going to look at those 2 months of business bank statements, and they're going to calculate what they think their COVID income is. And what's happening is it turns into a worst case scenario. So you can have someone that's got 24 months of averaged income that qualified, and then now this COVID comes in and maybe they didn't make as much money over the past 2 months. And now the underwriters are being required to use just those 2 months. And so, if it's half of their normal income, we have to take half their income out on qualifying now.
Wow.
So this is a huge problem for self-employed people, because a lot of self-employed people really weren't working that much during COVID.
Yeah.
A lot of them were staying home because they could.
On top of the fact that they're already getting whammied because they're the only borrowers that are required to qualify off of net income, where every other W-2 buyer is qualified on gross income. So they're already at a disadvantage as a self-employed person. Now they're at a double disadvantage. It just makes it even tougher. So.
And it's a Fannie guideline now. They brought it out. So what I've been explaining to my self-employed people that I'm under contract with right now is we have to check all this stuff on people because this is how they're calculating income. Based on the guideline they shot out. And update it to everyone. So we got hit with it, and now we have to go through our pipelines and search out who this is going to throw some hurdles in their approvals. Wow. So it's all lenders are getting hit with it. There's no way to turn your eye to it and just still close it. It's not an overlay for the mortgage company. It's a guideline that got updated like overnight.
Yeah, literally. So I guess on a positive note, I guess let's just, we'll conclude with this, is to talk about the rates right now, because they're continuing to be amazing. And so I guess tell us what we're looking at rate-wise right now and kind of what you're seeing.
I can kick that one off. I had I had a past client of mine call me today wondering if she should refi, and she was at a 3.25% rate that I put her into in 2012. And I just love this lady. I talk to her probably 3, 4, 5 times a year, but it reminded me, it was a good reminder, and it reminded me of how good rates have been for so long. I mean, if you really look at it, all of this low rate environment started in the spring of 2009. And it's just we've been on a run for 10 or 11 years. And we spiked a little bit 2015, 2016. But I mean, what did we spike to? 4%, maybe 4.25% at the worst. I mean, that's still, ridiculously low. And now here we are back again where rates were at or below where they were at 8 or 9 years ago. I mean, I would just encourage everybody. I know we all work probably 95% new construction purchase business, but if you haven't refinanced at this point, I mean, you need to get on the phone with a lender immediately and look at that. Or if you're teetering on purchasing something, you need to get into the market now and capture these rates, because it's at some point, and I've been saying this for years, at some point it's going to happen. Rates are going to go up, and you're going to wish you'd have been in this market. I mean, it's just spectacular. I mean, there's no other way to describe it.
I agree.
And another thing that, we're seeing right now with the competition, out there, everybody's rate shopping. And so what I always, advise people to pay attention to is when you hear, that a rate is, 2.75 or 2.875, you got to check and see if there's any points to buy that rate down. Because that typically, if you call one lender and they're saying it's 3.25 and you call another lender and it's 2.875, that 2.875, there's some cost to get it down to that. And so you got to make sure that you're comparing apples to apples. I advise a lot of my clients to buy their rates down, so they end up, going that direction. But people are doing it in this marketplace right now to try to capture the business. And then what happens is you tell your neighbor, oh, I just locked in at a 2.75 on a 30-year mortgage. Well, that neighbor calls their lender and says, I hear the rate's 2.75, but they didn't realize, they didn't see the fee sheet. The person paid $2 or $3 grand to get the rate. So you got to make sure that you, have a good mortgage person that you trust. When you hear things, pick up the phone, call them. We pull rates for people all the time that even aren't looking to do something right then, just to, let them know that we want to be your mortgage person, your financial person for the rest of your life. And so, we'll always steer you in the right direction and, let you know, hey, there are options to get that rate down, and I can show you that same way. But I can also show you the way that's not going to cost you anything. And that's really where the market's sitting.
So true. And, I guess it's the big thing right now is, the rates are great, jump in. Prices have not increased significantly yet, but I do think that they are going to, just from what I'm hearing on the new home side. Lumber's increasing, subcontractors are spread thin, so they have the ability at this point, because there's the demand, to raise their prices and everything. So, it's just one of those things. So we're just going to, now's the time, and people need to jump into the market and, do what they need to do. And I think, by people spending time at home, they've got to see that, maybe they want something different with their house and that kind of thing. So it's, definitely one of those things at this point. So I appreciate you guys, but tell us how people can get a hold of you guys.
Jason.
Yes. All right. So you can get a hold of me, jason.smith@southeastmortgage.com, or you can reach me on my cell phone 7 days a week at 770-377-5166. I respond to calls, texts, and emails.
He sure does. And I will say that he's available 7 days a week, which not all people out there, loan officers out there, do that. So it doesn't matter where he is, he's pretty much reachable, and that's awesome. So definitely reach out to him. And if you need help with real estate, you can reach out to me, Tamra Wade, 770-502-6232, or go to tamrawade.com and you can see what inventory we've got there, neighborhoods and everything. So have a great day. Thank you, guys.
Thanks for having us, Tamra. We enjoy this.
Thank you.